You will likely never understand how privileged you are in terms of having access to the stock market. It has never been so easy to buy pieces of the world's largest companies. It's quick, easy to access, and commission free. But here lies the question, is it actually free? Well, this is the subject for today's video. Are platforms like Freetrade, Trading212, etoro actually fee free? And if not, where is the money coming from to fund these platforms? Are there hidden fees that you're not aware of? Are they selling your data? Or are they inflating the share prices that you're purchasing? Let's find out. Well, the answer isn't the same for all of us around the world. The UK has some very different laws that significantly change the way that investing apps work in the UK as opposed to abroad. You might have heard of Robinhood, for example, in the US, that have a very, very different model to ours over here. More on them later. Let's take a look at the biggest investment apps in the UK and understand how they work and how they can offer their services for seemingly nothing. Are they running their platforms for the very goodness of their own hearts? Well, I'm sorry to be the bearer of bad news, they're not. And I don't think many of us are expecting them to do so either, if we're truly honest. Let's dive into it and look at all the ways they silently claw money away from you, just so you can be aware of them so you don't fall into any costly pitfalls in the future, because it actually might cost you more than you might think. The first way they do this is with currency exchange rates. This is often overlooked, but when you're buying a company from overseas, and I'm going to take a stab in the dark and say you likely are, as actually a lot of the market is made up of US companies, then you are being charged an exchange rate fees every single time. But it can't be that much, right? Well, before I show you the impacts on your investments, let's just quickly run through how the big three charge you for currency exchange rates. So the big three, the lowest is Freetrade at 0.45%. Next is etoro, and they work that out as 50 pips. This is a fairly odd way of working this out in my opinion, and I'm not going to go into the details of the maths, but it basically works out at about 0.45% to about 0.5%, depending on the currency exchanging from and to. And then the heaviest of them all is Trading212 at 0.5%. You might think this isn't a lot of money, but then consider this. Let's assume that your money is going to be converted at least twice. Once when you're changing your sterling into US dollars, when you're buying a US stock, but equally when you sell that stock from US dollars back in sterling. Based on this, you're taking 1% off your returns straight away. Remember, this is a minimum though, as you're going to buy and sell your stock at least once every time. God forbid if you're jumping in and out of stock multiple times. So every time you buy into a stock, you need to factor in that you're starting from a position where you're down 1% due to these fees alone. Don't get me wrong, it's not a deal breaker, but think how many times you might buy and sell a share of a company. The amount could add up really quickly over several months or even years of trading. The next way they get you is with account fees, which come in a range of different shapes and sizes. Some which are very much posted on the door of the apps, and others are a little bit more hidden that you might not find out about till 12 months later. The only platform which avoids this section is Trading212. They do charge through the teeth for exchange rates out of the big three, but at least they don't have any fees in this section, so I'll give them some credit. Freetrade currently have fees on two different account types. It is worth noting that you don't need to have these accounts to buy and sell shares, but you will most likely want one or either of them due to the benefits they give. They currently charge £36 a year for a ISA account. Yep, the accounts that you need to protect your investments from the taxman. The other account fee costs a little under £120 a year, which is for one of their premium accounts, which is referred to as Freetrade Plus. etoro don't have account fees as such, but they do have a fee which certainly feels like it belongs within this category. If you do not log into your account for 12 months, they will charge you an inactivity fee of $10 on your remaining balance on your account, which I think is a little bit harsh. And that's not $10 a year, that's $10 a month. So I can't say I like that one at all. Next we have withdrawal fees. Trading212 and Freetrade allow you to withdraw your money without any fees, which I think is pretty much expected. But etoro want a piece of your gains, or losses I guess. When you withdraw money from them, they'll charge you $5 for withdrawing every single time. As this is a fixed fee, it could be a large or small percentage based on the size of your withdrawal. Imagine if you'd invested $100 into etoro and you made a 10% gain on Apple. Well, once you'd paid the currency exchange rate cost, that's $1 of your profit gone. And then if you want to withdraw your money, that's another $5. So that $10 gain you've made is now a $4 gain. It makes a large impact, so it's definitely worth considering. If you haven't got a lot of money to invest right now, then etoro might not be the platform for you. These are more of the doom and gloom examples, but there are other ways these investment apps make money which aren't directly taking it out of your pocket. One method they have is based on the fact that they have a lot of customers that have a lot of leftover money rolling around their accounts. You can imagine how much money this is across millions of customers. Well, these platforms don't just sit on this money looking at it, they actually get this money out there working hard for them, so they'll lend it out at a return. So your leftover change could be several million or even tens of millions to these investment platforms. If they can get a 2% return on, say, £10 million that's been left over by customers, they're making £200,000 for them every single year. There's one other hidden fee that you might have heard about before called payment for order flow. Should you be worried about this? Well, I've actually asked my good friend Lewis from IQ Investing to let us know more about payment for order flow and its potential impact on us. Over to Lewis.
Thanks, Nick, and hello everybody, it's Lewis here from IQ Investing, where we talk about saving, investing and everything in between. So, payment for order flow. What is it, and do you need to be worried about it? Well, to understand how it works, let's first take a step back and understand what order flow is. When us, the average investor, wants to buy a stock, we place an order request with our trading brokerage. That is, Trading 212, Freetrade, Robinhood, etc. We don't actually purchase the stock from a brokerage. They are really just a middleman. At the other side of the trade sits the market maker. The market maker is a firm or individual that holds securities and provides liquidity to the market. They allow the brokerages to buy and sell shares at a set price. For example, the market maker could offer to sell shares of stock X to the brokerage for £5.5 per share, but they could also offer to buy shares from the brokerage for £5 per share. Of course, this offer is beneficial to the market maker, and the difference between the two prices is known as the bid-to-ask spread. The bid-to-ask spread is how market makers make their money. The wider the bid-to-ask spread, the more money they make. However, the lower the bid-to-ask spread, the better the deal the brokerage gets, and the less fees the investor will have to pay. So, as investors, we want our brokerages to get the best deals possible, with the lowest bid-to-ask spreads from the most competitive market makers. But here's the catch. Payment for order flow is where brokerages are compensated for directing traffic towards a market maker. The brokerage basically gets a slice of the profits that the market maker makes on the bid-to-ask spread. But wait a minute, this is a huge conflict of interest. If the brokerage gets a slice of the profits, they will more likely select a market maker that has a wider bid-to-ask spread, so that they make more money. This of course will hurt the individual investor, as they will not be getting the best deal possible. Despite payment for order flow being extremely controversial, the SEC in the US has done little to stop it. But thankfully, you'll be glad to know that payment for order flow has been condemned by the Financial Conduct Authority in the UK. Regulation has saved the day, so we can't be conned by dodgy brokerages that are only looking out for themselves. We can be more confident that all brokerages are getting us the best price possible when it comes to bid-to-ask spreads, so we don't have to worry about it. Back over to you, Nick. Thanks for having us on.
Thanks, Lewis. I really appreciate your support. I'll put a link to his YouTube channel in the description below. Lewis and his brother Matt have some really great insight all around investing, especially in the UK, so I would definitely recommend you check them out. Maybe let them know that you've checked out one of their videos since watching them on here. Anyway, considering what Lewis had to say, is it any surprise that Robinhood have pulled out of launching their app here in the UK? Their main source of income is banned, and the remaining methods are most likely not profitable enough to go up against established players in the UK. This video is by no means meant to say that you shouldn't be using these apps. I just think it's really important that you know the fees hidden behind the scenes. I actually think it's a great sign of progress that pretty much anyone can have access to the markets right now. And on top of this, I'm actually planning on using 2 of these platforms in the future. I just object to the fact that these platforms love to throw around the word free, and I think a lot of people misinterpret what this might mean. If the fees aren't posted on the door, then there must be hidden fees elsewhere, or it wouldn't work at all. I often get asked why I don't use Trading 212 to buy Vanguard funds, and it's for this following fact. I would much rather deal with a platform or company who is transparent about their fees and what their costs are over one that isn't. If I'm going to put the vast majority of my investments with just one provider, then having a high level of trust is my number one priority. And at that very moment, it's Vanguard, as they're very transparent on what their costs are. But I would love to know your thoughts, so let me know in the comment section below. That's all for this video. See you in the next one.